Hey, Davis here, and welcome to this masterclass on rolling short puts. Now, if you've ever wondered how and when exactly to roll your short put, then by the end of this video, you're going to learn everything you need to know about rolling short puts so that you can start rolling your short puts like a pro. Alright, so first off, we want to know exactly what does rolling mean and why even roll in the first place. So, rolling basically just means to close out your current option position and then simultaneously open another option position in one order ticket. So in our case, because we have a short put, we have sold a put option. To close it, we have to buy it back. So we buy back our current short put and then we sell another put option. So we do all this in just one ticket. So as you can see, this is just the process of rolling. It's very simple, right? So in this example, you can see that we have bought back the option on the 12th of August, and then we sold another one 2 weeks out on 26th August, and for this we keep the same strike, and then we receive a credit for it. So it's very simple. We basically just close out the current option position, open another one, and the key is to get a credit for it. So why do we want to roll? So there are 5 reasons to roll a short put, right? So the first reason is to improve your probability of profit. So let's say, for example, you have a short put at $100. All right, you sold a short put at $100, then you decided to roll after the market decided to drop, right? If the market drops and then you want to roll, so let's say you could roll it to 95. So what does this mean? So previously, if you had the short put, the only way you'd be able to sort of capture the full profit on this short put is if the market goes above 100 and your put option expires worthless, right? But now that you have rolled it down, the market can come down to even $96, and then if it stays there at expiration, you still make the full profit on this premium which you have received for selling the original 100 and then for the credit for after you have rolled it down to 95. So now anything above 95 is a profit for you. So that is why we have a higher probability of profit compared to when we had the short put at 100. Now the second reason is to give more time for the trade to work out, right? So when we are rolling, we are also extending our time. So you can see we have extended from the 12th August to 26th August. This way, if you didn't roll and the market went below your strike of 112, on the expiration date, you'll be assigned on the shares. But if you have extended it, you're giving it another 2 weeks wiggle room, the market could just go back up above 112 and it expires worthless, and then you'll be able to receive the full credit. So it gives us more time for the trade to work out. Now the third reason is to reduce the chances of getting assigned. So this is one of the biggest worries or concerns that many people have when they are selling options, is that they're getting assigned. So in this case, with a short put, when you're assigned on the short put, it means that you'll be buying 100 shares of the underlying stock per contract. So when you increase the time length from 12 to 26 or to however far away the expiration date is, you reduce the chance of getting assigned, because normally people wouldn't want to exercise their option until it's much closer towards the expiration date. For example, if you bought a put option with about 200 days left, would you want to exercise it right now? Even though the market is down, most likely not, right? Chances are that you wait closer towards the expiration date to see whether is it still below your strike price before you decided to exercise it. So this reduces the chances of getting assigned. Now the fourth reason is to get a better assignment price. So in this case, most likely the stock has gone way below your strike price. So again, let's use this example. Let's say if you have 100, let's say the market has dropped all the way to maybe, I don't know, $70. Now you'll be surprised that you actually may not get assigned if there's still quite a number of days left to the expiration, right? I have many options before where it has gone deep in the money, but I haven't got assigned on it because the DTE is still more than 30 days. So sooner or later, if you let this go closer towards the expiration date, then there's a bigger risk of you getting assigned. So if you want to get a better assignment rate, one way is to just roll it down. So for example, if you roll it down to $95, so in the eventuality that you actually do get assigned, you get assigned on $95 rather than on $100. So this gives you a better price on your stock, which is a $5 difference, right? So if you know you're going to get assigned anyway, you rather get assigned at a lower price than a higher price. Okay. Now, the fifth reason is cost basis reduction. And this is one of the key reasons why a lot of people like selling puts, because you get all these credits, right? And this credit can really help reduce the cost of the stock, the underlying stock, if you were to get assigned. So in this case, let's say 112, you get assigned on it. So instead of buying it at 112, you first of all you'll be assigned at 112 of 100 shares, but when you have the 82 cents, it will be reducing the overall cost of this, right? So you minus 0.82, so this gives you roughly an average price of 111.18, right? 111.18. So if you had not received this credit at all, you'll be going long at this price. But imagine if you could keep rolling it down, and each time you get a credit, this will reduce the cost basis of this price until you could even get all the way down to maybe 110 or even lower. Okay, so next, there are different type of short put rolls that you need to understand when we are rolling short puts. The first of which is rolling out. So rolling out just basically means to roll to a further expiration date. Very simple. You are basically just adding time. So in this case, you see we have rolled from 12th of August to 26th of August, and we get a credit. As long as you keep the same strike and you're rolling out to a further expiration date, you will mostly always get a credit. Unless it's extremely deep in the money, then most likely it's harder to get a credit. But for the most part, you will be able to get a credit because you're adding time. The next type of roll is rolling out and down. And that's a combination of two rolls. So basically, you're just rolling to a further expiration date, and then you're rolling down to a lower strike price. And for this, you should be able to get a credit, because whenever you're rolling out, you get more extrinsic value, and you can use this extrinsic value to offset the lowering of your strike price. So this is the most common roll that you would do, or most people would do, because it just lowers your strike price and increases the chance of you profiting on this trade, right? So when you lower the strike price, there's a lesser chance for you to get assigned as well. Now, the third type of roll is the least common type of roll, but there are some people that actually do this, and I also have done this before, and I'll show you a trade example later on of when I would roll up my put option, because most of the time nobody really wants to roll up, right? If the price, let's say for example, you had a strike at 112, and if the stock price does not touch 112, it just dwindles somewhere above here, all you have to do is just let it expire worthless, and you just receive the full credit of the short put that you sold it for in the first place, right? There's no need for you to roll it up to a higher price and then risk the market coming down and then you getting assigned at this price, right? So this is the least common roll, but normally when people want to do a roll up, that's because they think that the market will continue to go up and they want to receive some credit on this. So for this, what you do is simply just roll to a higher strike price. Now, there's one thing you notice is that you do not see a roll down. You do not see a rolling down just on its own. And the reason is because when you roll down, it will never be for a credit. You see, when you're rolling down, you're actually having to pay rather than receiving a credit. And that's because the option prices are getting cheaper and cheaper on the way down, right? So for example, if you have a 112 strike price versus a 100 strike price, this will always cost more for a put compared to this. So if you are rolling down, what you're doing is you're buying the more expensive put option back, and then you're selling a cheaper one. So this will never give you a credit. It will always be a debit. So let's say, for example, you're buying this back maybe for, let's say, $5, and then this all the way back down, you can only sell for $1. Then your net is actually a negative $4. So that is why people don't really roll down, and I wouldn't suggest that you roll down as well unless you have a very good reason for wanting to do that. All right, so basically these are the three types of roles. So now that you know the three different type of roles, when do you exactly roll them? Okay, so there are three scenarios. So the first scenario is when the short put is in the money. So this is the most common one. So for example, you have a short put, say at around 109, and the market has dropped down to 101. So this is in the money already. So this is the time where you want to start rolling to avoid, getting the possibility of getting assigned. So once you roll, most likely you want to roll out and down. So you roll to a further expiration date and you try to roll as far down as possible of a strike price that you can get. Okay, so this is the first scenario, which is to roll when the short put is in the money. Now the next scenario is when the short put is at the money. Now this is the most defensive, right? So you most likely do not want the put to have any chance of getting assigned. So in this case, you wait until the stock price basically reaches your strike price and then you start to roll. Okay, so most likely you'll be doing a rolling out and rolling down to a lower strike price. So this is the most defensive and also the one that you have the least chance of getting assigned. But the drawback of this is that you would have to keep rolling out to a further expiration date the moment the price reaches. So imagine if you had from this price, you rolled down to say a price around $90, but if the stock drops again, you have to roll out again, and each time you're rolling out, it's always a further and further expiration date. So if you started off with 45 days, if within the next 5 days you roll, the market has dropped down to your next strike price of your short put that you rolled to, so 5 days has passed, so now from 40 days you will be rolling to maybe 90 days, right? So, and if another 5 days has passed and it dropped again, then you want to roll from here. Maybe this time you have to roll to 150 days. So what happens is that if the market does go up, you can't exactly realize this profit immediately. You have to wait until the 150 days have passed before you can realize the full profit, the credit that you receive on the short put and the subsequent roll. So while it is the put rolling option where you get the least chance of getting assigned, it's also the one where it takes the longest for you to fully realize your profit. By the way, if you've enjoyed this video so far, I'd appreciate if you hit the subscribe button and just give a thumbs up so I can create more videos like this for you in the future. Alright, back to the video. Okay, so the third scenario to roll is when the short put is out of the money and the market is going up. Now this is the most aggressive, and this is also when you feel that you have no chance, or there's very little chance for the market to come back down again after that. So for this, you want to try and capture more profit on the short put, right? So for example, if you have sold this, let's say for $1, and you see that, hey, there's a support down here, and maybe you look at the indicators, it's indicating that it's oversold, and you think that instead of this going down, you're thinking that there's a very good chance it could go back up. So what you could do is to roll it up. Maybe you can roll up below this support area. All right, you can roll below this support area. Let me just change the color. So you can just roll up to the next support, below the next support, maybe at $96. And then for this, maybe you can collect an additional maybe 50 cents or maybe even $1 on it. So this way you get both of the credit, total of $1.50. So if the market really does shoot up in the end and expires above this strike price, you get this full credit. So this is the most aggressive way that you want to roll. And in fact, I have actually done this on a trade on FICO, which I want to share with you right now. So this is FICO, which is Fair Isaac Corporation. So on this date, basically I saw the market was coming down. It has been oversold for quite a while right now, and the market has been coming down quite very strongly. So I decided that, hey, on this date, I wanted to sell a put because I feel that Fair Isaac Corporation, FICO, is a pretty solid company, strong fundamentals. They are the one with the FICO credit scores, and most of the institutions right now are still relying on FICO scores, to assess their clients. So I decided that, if I were to actually get filled on the short put, I wouldn't mind as well because I have the cash. So For this trade, on the 18th of November, you can see down here, I sold the 360 put and received a pretty nice credit. It's about $14. So what I did down here is I sold pretty much an at-the-money put option. I sold an at-the-money put option for 360, received $14.10. Now, a few days later, right, just a few days later, only roughly about 5-6 days or so, right, the market went below my strike price. My initial strike price was at 360, okay, and then it went down all the way to around 342, which is roughly down here. So this was roughly where my break-even price is. So I thought to myself, you know, I think I want to try and roll out and down to try and get a better price, right? Because at that point of time, it seems like, you know, there's a lot of relentless selling. And I just figured that if the market was to continue to go down, I would like a 350. I wouldn't mind a 350. I mean, 360 was good, but if I could get 350 filled, I wouldn't mind that as well. So what I did was I rolled the short put down to 350 and I received a credit of 76 cents. So that's $76. So as you can see, rolling again just means to buy back the 360. I bought back the 360 and then I sold, right? To open, I sold the 350 put. So in essence, I'm basically just closing out this loss and then selling another one to make up for more than the loss that I made. So this is essentially rolling. So I rolled down to the 350 strike price. Now let's see what happens next. So on the 31st of December, the market shot up, right? FICO went all the way up, and in hindsight, it was quite unfortunate that I didn't get filled, because it would be fantastic if I had been filled at $350 and I would ride this profit all the way up here. But of course, as fate would have it, that the market started to rally back up. So when it rallied back up so strongly, I felt that, you know, there was very little chance that it would come all the way back down to 370. So instead of just getting that, you know, to be satisfied by just letting my option expire, I decided to roll up. So I wanted to roll up to the 370 strike price, which I felt was still quite a decent distance away from, you know, my short put getting touched. So on this date, on the 31st, what I did was I bought back the 350 put and then I sold the 370 put. So this is basically me rolling out. I rolled it to a further expiration date, and then I rolled it up as well. So this gave me an additional $2.43 in credit, total of $243. So this is one of the reasons, or one of the times, when you also can consider rolling up, when you can see, you know, there's a strong move up and you think that the market has a stronger probability of it going up than it going down. So true enough, later on expiration date, it expired worthless. So as you can see, from this point on, it shot up even more. So like I said, you know, as fate would have it, I didn't get filled at the 350 or 360. You know, if I have gotten filled on this, it would be a very nice profit, right? But that's fine as well, because I've got a pretty decent credit altogether for this trade. So this trade, you can see total I made $14 plus $2 and another $1 between these two. So total roughly about $17. So that's $1,700, which is not too bad for this trade. All right, so I want to explain to you the difference between rolling short put when it's in the money versus when it's at the money. And this is very important to understand, because it is understanding how you transfer extrinsic value. So for this, just take a look at this example. This is IWM. So right now the price is 178.69. So let's just take 179. We'll just round it up, right? So let's just imagine right now the price is at 179. Okay, so let's compare the two different rolling. So for this one, you can see that this is your rolling and in the money put. So the strike price which you are rolling from is from 185 to 180. So what this means is that you originally had a short put at 185. Okay, you short put at 185, and then the market All right, the market most likely, right, it went all the way down, okay, to the 179 price. So your short put is now in the money. All right, so what you did is you rolled it. As you can see, you rolled it from 185 to 180. So we rolled it all the way down. Let me just change the color on that. All right, we roll it down to 180, which is pretty much at the money. And then you notice that we are able to still get a credit for rolling this. So this is 23 cents and we roll out to a further expiration date. So this is the lowest strike that we could roll down to get a credit. If we were to roll any lower, this would become a debit. So as much as possible, we always want to keep it as a credit. So when we roll down, we could roll down $5 in strike price. Okay, so if this is an in the money roll, this is an in the money put option. So let us compare it if we were to roll it when it is at the money. Okay, so let's say the market now comes down here, and then when it touches our strike price at 179, in this case 179, then we decide to roll. So from 179 we can roll it all the way down to 170. Alright, you can see 179, we rolled down to 170 and we could get a $3 credit. So this is the lowest that we can roll to for a credit. Okay, so if you notice, this roll is a $9 roll. Whereas for the in the money put option, you could only roll down $5 in strike price. And the reason is because now, if you already watched the video where I talk about in the money put options, you will remember that the in the money put option consists of two values, right? First, you have the intrinsic value, and then you have the extrinsic value. So, recap: intrinsic value is just basically the difference in price between the strike price and the current stock price, right? So this in the money. So the reason you cannot roll much to a lower strike price compared to the at the money roll is because most of the value of this in the money is intrinsic value. That means you have very little extrinsic value, and we have very little extrinsic value. There's not much you can transfer to the following expiration month, whereas for the at the money it is 100% extrinsic value. So there is a lot of extrinsic value for you to transfer to the following expiration date. So that is why when the when the price is right at the money, you're able to roll much further down compared to if you had that in the money put option. Now this rolling down will actually this $5 you see down here will get lesser and lesser as you get deeper and deeper in the money. So for example, if instead you had another strike, let's say your strike is 190 instead, then in this case you wouldn't be able to roll down $5. You probably may only roll down maybe $2 to $3. So this is the thing to understand. The further you let your put option get in the money, the lesser you're able to roll down the strike price. All right, if we were to compare to the same expiration date as the at the money. All right, on the other hand, the positive side of waiting until it's in the money before you roll is that you actually give time for the market to recover. You give time for the stock to actually rebound back up, before you decide to roll. All right, so for example, you had a short put, let's say at $180, and let's say the market goes down. All right, it could, before you decided to roll, it could come back up, right? So in this case, some time has already passed, and when it goes back up, a lot of the extrinsic value which you sold it for initially would have already expired. Now if you had actually rolled it the moment it touched your strike price, so let's say in this case, let's say you decided to roll it the moment it touched this strike price of your short put, and you decided to immediately roll it down, then what happens is that you have already extended your time. So maybe this is from say 30 days, you have rolled it out maybe to 60 days, and then the market actually did go back up in the end. So that means in the first place, you may not even have to roll this short put because it went above the initial strike price which you had. And then maybe some time would have passed and then you'll be less than 30 days and you can just wait a little bit longer. And this could most likely expire out of the money and you keep the whole credit. But because you have already rolled down, instead of waiting just 30 days, you now have to wait much longer before you can realize the full profits on this strike price which you have rolled down to. So this is the difference between rolling in the money and at the money, and it's very important for you to understand, especially when you start to make the decision to roll your short put. Okay, so now I want to share with you 3 systematic methods to roll your short put. Alright, so the very first method is to roll when there's 21 days to expiration left if it's in the money. If it's out of the money, you don't touch it. The moment it gets in the money, then you start to roll it. So for example, let's say you have a put at 180. Alright, let me just change the color of that. Let's say you have a short put at 180. So during this whole time, let's say you sold this during the 45 days to expiration date. All right, there's 45 days to DTE. So during this whole time, regardless what the market do, if it goes down, up, all the way down, no matter where it goes to, right, you do not do any rolling until you reach the 21 days mark, until it becomes 21 days to expiration. So when 21 days, you look at your position and you take a look at where it is. If it's in the money, then you start your roll. If it's out of the money, you leave it alone until it becomes in the money, then you start rolling again. So there are some pros and cons with this. So the pros is that this is a very simple method of rolling and the least time consuming. So if you don't really have much time to stare at the screen, or maybe you have you're working full time, then this is the best thing, because all you have to do is just monitor when it's 21 DTE, look at your position. If it's in the money, you roll. If it's out of money, you just leave it. So that's a very simple way to manage it. And there's also a very low probability of getting assigned because there's still quite a number of days left to expiration, right? Now, of course, you still can get assigned if it's very, very deep in the money. If you want to play safe, you could maybe just roll it instead of 21 DTE. You could say 30 DTEs. You could wait until 30 DTE and you see if it's in the money, then you decide to roll. Because chances are when there's still 30 days left to the expiration of this option, there's still quite a bit of extrinsic value. So when there's quite a bit of extrinsic value, there's very little chance that this option will get exercised. So when you keep it the rolling to a number of days like this, there's very little chance of you getting assigned. And at the same time, you also allow time for the trade to work out. So for example, as I mentioned earlier, let's say you have a 45 days DTE and this is the strike price that you have, say again at 180. Now, if you decided to roll the moment it touched this strike price, it may touch maybe in 3 days, then you're going to roll it down immediately, say to 170, right? But if you just use this 21 DTE method, it may just go down and then come back up. And all this is before 21 DTE. So you didn't have to do anything at all. If you base on this 21 DTE, you didn't have to roll at all. So it allows time for the trade to work out in your favor as well. Right? So those are the pros. Now the cons is that it could be deep in the money when it's time to roll. And when it's deep in the money, as I shared with you earlier, it becomes harder for you to roll down. Right? There's lesser strike price, and in certain cases, if it's so deep in the money, you realize that you can't even roll down unless you roll to extremely far away, right? Like maybe a year out, then you can roll down. By then, it would kind of defeat the purpose of a short put, because short put is meant to have theta, you're meant to have time decay. And if you were to sell an option that is 1 year away, the decay is so little that it kind of defeats the purpose of selling the short put in the first place. So this is one of the cons. The second thing is that you may not be able to roll for a credit, as mentioned. So if very deep in the money, then it'll be very difficult for you to roll for a credit. And in some cases, you will realize that even though you roll out to a further to a further expiration date, but still the same strike price, you actually have to pay a debit. right? Because of the bid and ask spread. At a further away, your bid and ask spreads become wider. So in this case, there's more slippage in terms of your order. So that's how you would, in certain cases, you would even get a debit rather than a credit. Okay, so the second method is the aggressive method, which I've shared with you earlier, and that is to roll when it's at the money. So the pros of this is that you won't get a sign, because the moment it reaches your strike price, you're just going to roll, right? If the market comes down here, right, you're going to roll it down, and if it drops again, you're just going to roll it down again, and you just keep doing this, rolling and rolling, basically to perpetuity, right? You roll until the furthest expiration date possible. And that's why you can roll to the furthest strike possible, because it's at the money. You have the most extrinsic value, as explained earlier, and also you have the highest win rate. Why? Because as mentioned much earlier in the slides, when you have a lower strike price, it gives a much better chance for the stock to eventually recover. For example, it's easier for the market, right, to go above 180 than it is to go above 190 or $200. Now, the cons of this method is that there is a longer expiration date, which means it takes a longer time to realize your profits. So this is some of the things that I've done before. I've tried to roll it at the money to the point where I was stuck with a short put of roughly almost a year to go. So I'll be stuck in that position, even though the market have since then rallied way above my strike price. The option, the short put which I had, still had many days left to go. Now I could definitely close it, but if I close it, there will be still some value that's lost, or you may not get more profit as you originally did earlier on because of these roles. And it's also the one which you have the most active management. So you can imagine that you always have to ensure that your platform, or rather some alerts if you have, that you will roll it the moment it touches your strike price. Now the third method is to roll when it breaches your break-even point. So there is a break-even point, which is basically the strike price and you minus off your premium. All right, so let's say if your strike price is $100, you sold it at 100, and then you receive $1 in premium. So in this case, your break-even will be $99. Right? So the moment the price, if it comes down to $100, which is at the money, you don't roll it yet. You wait until it goes to $99, then you can consider rolling. So this is what it means to roll when it breaches your break-even point. All right. So what are the pros? The pros is that you give more time for the trade to work out. So compared to this, if you were to wait until it goes in the money, all right, it may just go back up before touching your break-even point. So in this case, you actually didn't even have to roll at all. And also you have a very low probability of getting a sign because you're not letting it go very deep in the money, right? If it goes to your break-even point, chances are it's not very deep in the money. So at this point, you still are able to roll out and down for quite a good number of points down, okay? Now the cons of this is that you can't roll the strike price down as far as the at the money roll. So again, I mentioned this earlier, at the money get the most extrinsic, so most extrinsic transfer, you get more, you get a lower strike price of rolling compared to this. And you need active management as well. So you have to always monitor when it hits the break-even point, then you start to roll. Alright guys, so this is the 3 systematic methods and this is the masterclass on rolling short puts. I hope you really enjoyed this video. If you did, please subscribe and hit the notification bell so you'll be informed whenever I release a new video like this. And as always, thank you for watching. I appreciate your time and I'll see you in the next video.